In this video, I'm going to discuss the accounting for troubled debt restructuring. And what we mean by that is anytime a lender grants a concession to a debtor, or in other words, anytime the lender reduces the loan or adjusts the payments to a loan, then that creates a benefit to the debtor, the person, the borrower, right? In other words, they're restructuring the debt. So whenever we have those kind of scenarios, usually it means that the lender ends up with some form of loss, and the debtor, the borrower, ends up with some form of gain, right? And sometimes this is a decision that is made simply because there are no other alternatives. We saw a lot of this going on during the financial crisis in 2008, 2009 in the United States, also called the Great Recession, where a lot of people that had borrowed significant amounts of money to buy a home, they found themselves eventually with a home that was worth significantly less than what they owed. And many times people abandoned those homes, right, without necessarily paying those loans. So in that case, it's a little bit more strange, but that was something that occurred. Usually what will happen is in those scenarios, you end up settling with the bank instead of just walking out of the home without arranging it, right? So what are the options? The options are, like I just described right now, you can settle with the bank. You turn over that real estate or whatever that asset may be and settle with that bank, or you can have the bank modify the terms of the loan. And I'll explain both in a minute here. First of all, this is what is most likely to occur instead of modifications. Modifications are more rare. Many times when you're in trouble, it's really hard to get your terms modified on the loan. And there's a lot of reasons why. One of it is if you start providing modifications to terms or granting better terms to a particular borrower, then you might have some form of contagion effect where people start seeing that, and then they too want other people, they would also want modification. So because of that potential contagion effect, you rarely see this happening. So a lot of times when a company or a person is in trouble, they might have to just settle and give up on that loan. So let me give you an example here. Assume that a bank currently has a loan with a carrying value of $200,000, and then the borrower currently has a home worth $150,000. Now here, it would help to think of the past first. In the past, when the bank issued a loan, they wrote a receivable and they handed the cash to the borrower. And then the borrower received that cash, and they recognized the liability, and they used that cash to buy whatever it might be, right? So in this case, I'm saying it's real estate. Well, in the past, I'm putting this value as X, but in the past, this could have been way more than what the current carrying value is, right? If the borrower has made some payments on this loan, so that potentially has reduced the carrying value. But at this point, today, when we're going to settle, after all the interest has been accrued, and we've done all the computations in terms of what the current value of that loan is, we notice that the carrying value of the loan is $200,000. And the real estate that the borrower is holding is worth $150,000. So you can imagine, perhaps in this scenario, that the borrower paid a whole bunch of money for this home, and now that home, and when I mean a whole bunch of money, I mean more than 200. And now that home is worth less than 200, but they still owe 200, right? So this might be a scenario where the borrower just can't pay anymore and they have to settle. Now look at what happens here. From the perspective of the bank, they have no choice. If this person is no longer going to pay, then they have to accept, or many times they take possession of the real estate and they put that in their books for $150,000. Then they have to reduce the receivable that was on the books that has a current carrying value of $200, and then they recognize that expense, that loss from settling this debt. Because notice, you are receiving, or the bank in this case is receiving $150,000 worth of something for a loan that is currently on the books for $200. So that's their loss. And if they've previously reserved for that, then you take it out of allowance for uncollectible accounts. Otherwise, it's some other expense. So for the bank, you have a loss, but then for the borrower, to get rid of the carrying value of that liability, you take out the real estate, and then that gives you a gain because you are settling something you owe at 200 and you're settling it for 150. So that gives you a gain. And what's tough about this is that for the person that's, in this case, losing their home, they have a potential taxable scenario because anytime you are forgiven debt, it becomes a taxable situation. Now, during the financial crisis, there were some exceptions made, but in general, the rule is if you are forgiven debt, that becomes a taxable situation for you. So not only did you lose your real estate, but you also now have to pay taxes on that settlement. All right. I'm also here assuming, if it's a business especially, that this is the value of the real estate, the fair market value is $150,000 and that it has been updated. In other words, you have maybe here you have a gain on restructuring, right, on settlement, but you might have had a loss on the real estate. If in your books that real estate is carried, let's say at $250,000, the purchase price, and now it's worth $150,000, well, upon realization of this transaction, you're going to have to recognize that loss. So I'm assuming that has already been done, okay? And we're just taking it out at its current fair market value. But keep that in mind. That could also be something that occurs. Okay, so at that point, you settle. You no longer have that liability. The borrower no longer has that liability, but you have that gain. That's the scenario where the settlement occurs. And this is most likely what will occur if a borrower finds themselves in trouble. Now, on occasion, you might be able to get the terms of the loan modified. But as I explained at the beginning of the video, this is a little bit more limited in nature and more complex. But if it does happen, then just think about the loan right here. Let's not use 200 here. Let's say X. Bear with me here, right here. And the reason I don't want to put 200 as the loan is because if this is the past, just think of the loan being issued for some amount over 200,000, okay? Even though right now I'm saying the carrying value of the loan is 200. In other words, the amortized cost is 200. So in the scenario of a modification, what happened in the past is the same as in this scenario here. But what happens now, it's a little bit different. Now the bank is either giving you a better interest rate, or the bank is extending the terms of the loan, or the bank is maybe, so if they give you less interest, if they reduce the interest, then your interest payments in a timeline like this will be lower, right? If in the past it was Y, then the new amount would be Y minus some amount. This is for the payment, interest payment. That's one possibility. The other possibility is that they reduce the principal. So if the principal was X from the original loan, like I stated right here, now it's going to be X minus some amount. In other words, when you analyze the modification, you compare the modification to the original terms. So what is the carrying value or the worth of a loan? It's going to be always the present value of all the future cash flows, right? So let's say the principal amount. Let's say that the principal originally was X amount and it was discounted at some rate, 10%, let's say the market rate, and that gave that present value of X in N periods at this discount rate gives you A, whatever that may be. Interest payments originally were throughout these periods for the amount Y, and then that gives us present value of those of B. So right now, the carrying value of that loan is 200,000. That would be A plus B. If the terms, so this is now where the modification comes into play. If the terms are modified, then this X might be a smaller amount. So if this X is a smaller amount, then A will be smaller. If these Y payments are smaller, then B will be smaller, and I'm going to call that C prime, okay? And don't worry so much about A, B, C, and all these letters. Just think about this. The present value of the original amounts, the original terms of the loan is 200,000 right now. But with the modification, I laid out the cash flows again, and I did this computation one more time, discounting at the market rate. And when I did that, the present value now gives me 190. In other words, that loan that used to be carried at 200 can now be carried in the books at 190 because the bank has made some modifications. Okay, now, if that's the case, then I need to, let's look at the bank. The bank used to have in their books a liability of 200, and now they need to reduce it by 10. So that note receivable, if you notice here, I go C minus C prime, C minus C prime, that will be the 10. Okay, that's the amount that the note receivable needs to be reduced by, and then that's a $10 loss for the bank. And then for the borrower, they reduce the liability by that same $10, C minus C prime, and then they recognize a gain for that amount. And again, this is a taxable scenario for the borrower. Okay? Now, don't let this confuse you, just think about the fact that that loan under the original terms has a present value. That's this present value. And then that loan under the modified terms, whatever modifications occur here, also has a present value. And it's usually going to be lower if you're getting modifications, right? So that's what this C minus C prime amount is, just the difference between what the carrying value would have been under the original terms versus the revised modified terms. So notice what I say here. The loss is based on the present value of the new cash flows compared to the 200. So this is the present value of the new cash flows. And then the potential gain, same thing, based on the present value of those new cash flows. All right. Now, this seems a little bit more complicated, but it doesn't have to be that complicated. It's just understanding the concept of present value of future cash flows, which in accounting we use a lot. The other thing I want to mention, despite that, this again is something that is not as commonly done as you would think. Okay, what normally happens is that when you are in trouble with a debt, you might have to just settle that debt, and that's this scenario right here. All right, this concludes the video on troubled debt restructuring.